All right. Welcome everyone to our whatever this is now 18th installment of the Enduring Planet and Friends Community Event Series. Uh, we are first and foremost very grateful to our sponsor, Wilson Sonsini, who's supporting our entire series, and we have Randy from Wilson, who will introduce himself in a moment. Um, we have a really fun event for you guys today. We're going to be talking about one of the least fun topics in fundraising, which is down rounds. Um, and just some housekeeping items. So if you're not speaking, make sure your mic is off and your video is off. The chat is available to everyone. We would love for folks to ask questions throughout the event. We will either introduce them into the panel flow or respond to them directly in the chat. And I encourage all of the speakers to keep an eye on the chat and respond in real time. The point here is to be very, very sort of tactical and actionable. And so that's kind of the intent behind the questions and the discussion topics. Uh, One thing I will say is if you're ever confused about an acronym or something, and please don't hesitate to chime in. We'll try to define things as we go, but we sometimes get caught up in all the finance speak and forget that not everyone knows all the lingo. Uh, we do these events every month. We are recording. We will post a summary and the recording itself probably next week. It just depends on when Hannah and I can write it up. And I think that's it. Hannah, any other housekeeping items that I may have missed? Amazing. Okay. All right. So we're going to do quick introductions of the speakers. As some of you may have noticed, we swapped one of our planned speakers. Ben had a baby yesterday, and so oh shoot. Well, it's public now because it's going to be in the recording. And Susan is here to share her wisdom. I'll just quickly introduce myself. So I'm Dimitry Gershenson. I'm the co-founder and CEO of Enduring Planet. We do two things in the climate ecosystem. We are a lender, so we provide working capital financing to climate companies, big and small. And we also provide fractional financial operations support to climate companies. We have about 80 that we work with now, everything from basic accounting all the way to complex financial modeling, M&A support, you name it. So that's us. And why don't we go around the room? Hannah, you want to go next?
Sounds wonderful. Hey, everybody. For those of you who know me, my name's Hannah. For those of you who don't, I'm still Hannah. I get to serve founders in the CFO capacity as they scale up and build their first large-scale infrastructure projects from a firm called Lupine Finance. In my past lives, I've worn the hats of a VC investor and have wound down companies, lost a bunch of money, have unfortunately seen more than I care to admit in these spaces, and very privileged to be among these speakers today, helping bring good tactics to all the founders navigating it in real time. With that, I'll throw it over to Randy, and a big thanks to the firm for supporting this series.
Oh, thanks, Hannah. Hi, I'm Randy Lewis. I'm a corporate and securities partner at Wilson Sonsini. Been at the firm for some time. About 20 or so years ago, my partner and I co-founded the firm's energy and infrastructure practice. Been working all types of transactions that you would expect. A lot of venture financings, a lot of M&A, a lot of capital markets transactions, and share Hannah's sentiments that if you're in this industry, you're going to get your hands dirty. So, pleasure to be here.
Awesome. Susan, you want to go next?
Sure. Hey, everyone, and great to see so many familiar names since we video off, but tons of familiar names. I'm Susan. I'm a climate tech investor at Toba Capital, where I started our climate practice. We also have a fund of funds practice, so I sit in a little bit on that. So I'm kind of direct and LP at the same time. I also host the Climate Money podcast and blog at climatemoney.substack.com. And I don't know if everybody knows this about me, but I've truly sat on both sides of this conversation. So as a board member and investor navigating down rounds across my portfolio, like investors don't like to talk about that, but I'm actually kind of proud of some of the difficult situations that we've been through, but also as a startup operator across 3 exits. So I'm really excited to get into the real talk today.
Awesome. David, you want to close us out?
Hey, I'm David. I'm the founder of Precursor. We're a leading folk advisory firm. We help folk companies raise hundreds of billion dollars in capital, help them broker billion-dollar PPAs with hyperscalers. We help them de-risk projects by saving tens of millions of dollars in CapEx and years in time. But probably what most relevant to this is I've been investing since 2000. I've seen multiple cycles, the internet 1.0, China 1.0, climate tech 1.0, and down rounds is part of the circle of life and innovation. And I think probably most know me for writing a lot of stuff on CTVC about folk.
Amazing. All right. Well, welcome everybody. Super heavy hitter panel. I'm very excited to dive into this. I think just to set the scene a little bit, we're in a funky financial environment these days, and down rounds have become more and more common. And so, in response to that, we wanted to bring this group together to talk about the sort of the logistics, the reality, what founders are seeing, how terms are navigated, what the gotchas are. And so, maybe we'll do a quick round robin to kick us off. So if everybody can just go and in 10 seconds say, what is like one dangerous misconception founders have about down rounds in today's market? And maybe we'll go Hannah, Randy, David, Susan.
Awesome. In rapid fire, the down round is not an existential, like world-ending aspect of the business. There are many instances of survival, surviving well, coming back stronger. Being any piece of a large pie is a better outcome than that pie going to zero.
Randy?
I would echo that. Sometimes you'll hear boards or founding teams or management teams say that come to you with the perspective we have to avoid a down round at all costs, or our reputations will be ruined and the company will never recover. And that's just not the case. As David said, it's these things come in waves, and we're coming out or coming out of a wave right now. We're seeing more down rounds. Sometimes they're just unavoidable, and sometimes they're the best option to salvage the company and get it back on track.
David?
I would say again, there's light at the end of the tunnel. We're fortunate at Precursor to have 20 plus clients. I would say more than a few of them have down rounds. And now, if you see them in the headlines, it just sounds like strength on strength. So again, there's a difference between what people say happened and what really happens. And it happens to everybody.
Happens to every investor, that's for sure. I will say something different. So I think in down rounds, there's a misconception that price is the problem or price is everything, or price/valuation, which are kind of different, but in the same ballpark. And in my experience, in my opinion, that's part of it, but the terms can also be what makes a round down. And so really broadening and trying to understand, which thank goodness we have Randy here today for this, but like really digging into the terms is where more founders need to be paying a lot more attention, and also investors.
Is a round a down round if the valuation is the same, but there are other punitive terms, in your opinion, Susan?
It's not technically because of how we narrowly define down round. But if we think about it from an outcomes perspective for founders, operators, insiders, and from an emotional perspective, I mean, what is a down round to you? Like anything where we're on smiley face, right? So I think terms can definitely make a round pretty down, as well as oftentimes down rounds can be accompanied by real punitive terms that need to be part of the whole picture, the part of the whole analysis and negotiation versus just fixating on one number.
Yeah. Well, way to blow up our entire run a show here, Susan. We got to redefine the word. I think, I want to clarify. So I actually really love this framing, and I want to come back to this as we talk today. I think we were operating when we set up the flow for this panel with this idea that down rounds are really about price, and I think this is actually a really excellent point. And so as we go through, maybe we can come back to this and like pick at it some more. Hannah and Susan, I want to like keep working on this context framing for a minute before we dive into the tactics. So when or where do down rounds usually occur? Like what triggers it, and why might VCs offer a lower valuation or more punitive terms in a subsequent financing than previous round? And maybe Hannah, you could start and we can.
Sure. I think there's a couple of reasons why they can happen. Market sentiment in general is probably one of the primary ones, and that means that often, especially if new money is coming in, evaluating the current stage of the business, the current risk outstanding toward getting to something that is a repeatable commercial machine. Down rounds will happen when the previous price did not represent that picture. And it needs to be corrected in a way. There's a number of other reasons, I think, exogenous to the businesses that don't really make a lot of sense, and that's when down rounds can be the most painful to founders, when it feels like today, in today's day and age, anything outside of data centers and AI at present are kind of coming in at lower valuations, or there's less appetite, and so you're taking a down round or trying to incentivize investors to come along in the journey because their attention is elsewhere. That really sucks. It's definitely happening. But I usually see that more as like a flat round, or just like difficulty in raising, needing to raise less. A true down round, I think, is most often on account of something went wrong with the business, something, milestones were missed, an assumption proved out not to be true, and investors still understand what a pivot could look like, but are trying to reset where they're starting and appropriately fuel the company for business. So market sentiment, mispriced previous valuations, exogenous factors given kind of demand, and then the fourth being kind of missed milestones.
Susan, anything you want to add?
Yeah, I think those are all really great. And just really quickly on something Hannah said about the kind of market appetite. I think that's just so unfair, and it's a lot bigger than people think it is. So there's kind of a mismatch between reality and expectations. That's the core reason, right? That's the big bucket. But then there's also just like capital markets as a marketplace. There's supply and demand. And if there's just not very much demand for your type of equity I mean, we've seen this in our own portfolio where there are businesses that are just killing it on their fundamentals. They're actually, in any other environment, they would be like, they would have no problem at all. And it may not result, like Hannah said, in a total down round, but some of the other like, unhappy effects could still come about. So that's just one reaction that I wanted to share. But from my view, it's kind of three things. One is actually, Hannah said this too, but I would call it overcapitalization. So when previous rounds were, which we also saw especially within climate tech in a certain era, not so long ago, where a lot of money was injected into the business because, again, that supply demand thing, there was too much demand and not enough supply of startups or of equity to purchase. And then the price gets kind of bid up in a way that is a mismatch that sets impossible expectations for milestones to be reached. So I really think a lot of times down rounds or flat rounds are foreshadowed by previous rounds, and founders and people in general, investors, everybody involved in the business can get very excited about those big numbers early on and even start calculating net worth and things like that, which is a huge mistake because none of that's real. And it's much better. I always counsel founders to be more conservative earlier, not as like a tactic so that I get a better price, but really with this in mind, with this eventuality. So that's one thing. And then two is like, and this is maybe a place where, Enduring Planet can really lend a helping hand. But in climate tech, we have capital intensity meets over-reliance on equity. Oftentimes, like we've got really long timelines. We've got lots of money needs, huge capital needs within the business. maybe that didn't all have to be equity, but at a certain point in time it was, or there weren't as many other options or products out there. Now that's starting to change. So that's one of the reasons for down rounds that we could potentially like avoid in the future. And then the last thing I will say is narrative stasis. Like when things change in the business or in the market, and as they often do, the best founders are really versatile and agile, and they know how to tell a change story. Sometimes for a series A versus a seed, you have to tell a new story, not just repeat the same thing, go out to market with the same investors. So have you been able to do that? I'll stop now because I could go on about that one, but let others chime in.
Yeah.
I think you create a perfect segue. So you talked a little bit about sort of people leveraging debt in these contexts. Randy, what are the options that founders have um, other than doing a down round, right? Like what started the landscape of things you've seen your clients pursue rather than take a down round?
Yeah, and board should, we can probably get into this later, but board should evaluate all the various alternatives that might be available to them. But there are a number, just a simple round extension, an internal round extension, where you're going out on you're raising money from your existing investors on a flat round, just basically extending the round, authorizing more shares and issuing more shares, and you can even open that up to external investors. You can do a SAFE or convertible round or convertible note round. Coming out of 2021, there was a lot of that. No one was going out to market. Everyone was doing things internally, either through a convert or through a round extension. Um, you can do a flat round. I mean, this goes into something that Susan was saying. You can do a flat round or an up round with a lot of warrant coverage or heightened liquidation preferences, which has the effective price, either effective price on outcome with a 2x or 3x liquidation preference, or the effective price immediately with warrant coverage provides the necessary incentives for investors to come in at a flat or a nominally up round. You can do a reduction in force. You can do other capital or cash preservation measures to increase the runway to buy yourself more time to either develop a new story, allow you more time to access new investors, but just buy yourself more time. Venture debt. Depending on the circumstances, it might be difficult to get to open up a new venture debt round or facility, but you might be able to pull the trigger on some allocated funds under an existing line, a venture debt line,
Just
and
emailed it to you.
sometimes the right thing, and I've had companies make the call that we're just going to wind down and return capital to stockholders. The path that we chose is not viable any longer for reasons that are within our control or outside of our control, and the best thing we can do now is wind down the company, return capital to stockholders. I've had companies make that decision, and in the process, they've stumbled upon something. And I just had a company that's just raised, multiple tens of millions of dollars after talking to me 6 weeks before, saying, we're going to have to wind down the company. And and it's important for the board to evaluate all these alternatives at the time.
Maybe if we have time at the end, I want to come back to that story because I'm curious how you go from we're going to wind down to let's go for raise tens of
Yeah.
millions of dollars. Um, so David, coming to you, what how should founders think about like when to rip the band-aid off and just accept the down round? So what does that process look like for the best entrepreneurs?
So I would say it comes down to just dollars and cents. The one thing people all need to remember is that you have to make payroll. If you can't make payroll, or, to use this very scary term, you enter the zone of insolvency, you have to make the decision. And I think the one thing that kind of Randy was highlighting and Susan was highlighting before is your existing investors have an incentive to kick the can down the road as long as possible. But you, as the founder, have to be the master of your own destiny. And you have to make the call. Because when you're in the zone of insolvency, that is when the debts of the company become your personal liability for both you as the founding team and the board members. And the one thing I need to highlight is that when I started Precursor over a year ago, I didn't think a decent part of my practice would be board management and coaching for founders to manage their board. Many investors who came in from climate tech are first-time VCs, and they've never seen a down round. They don't know the zone of insolvency. So you're not getting the counsel you need at the board. So you have to be your own counsel.
Yeah, I think that that issue, coming back to sort of Randy's points about other options, this is also a problem that we've seen in the market where folks will go to their board and they'll say, okay, like we're at, 6 months of runway, 3 months of runway. We've done these options. Um, we have, we've explored these things. We have XYZ, and they get pushed into a down round because people are like, oh, well, you can't possibly borrow money against this contract. You're a startup. Or, oh, you shouldn't do a reduction in force. You should just do a down round. Or, oh, like, well, we'll help you get whatever terms. Like, I think having additional counsel to navigate all the options is really important really early on. And whether that's, lawyers, outside advisors, your board, like it's really important that founders take agency and don't just defer to,
And
whatever investor led their last round to
so
comment.
I have multiple clients where they essentially have two boards. They have their investor board with the fiduciary responsibility. They're the ones who put capital in the board in the company. And then they have their kitchen cabinet, who are the people they actually really talk to when they have hard problems.
Yeah. Yeah.
And
We often
again,
recommend folks have shadow boards where you have like
yeah.
other founders, other people that you sort of involve in your decision process so you can get a really good
And
picture.
and it's important to have that kind of safe space where you can say anything because for many founders and VCs, your interests are not 100% aligned.
Yeah.
And going back on some of Susan's comments, like you can predict a down round fairly easily because many companies that were birthed under Biden raised 100, 200 million dollar Series Bs. And that kind of irrational exuberance and kind of that infinite growth thesis is hard to underwrite again
Yeah.
for the Series C and the Series D, especially when the macro has changed.
So let's talk about the tactics of navigating this tough conversation because board misalignment while trying to close a down round, especially when you're like running out of cash and potentially can't pay people, that's a real problem. So maybe Hannah, Susan, let's start Susan, then go to Hannah. What are the tactics that a founder should employ to like really manage the conversation with internals, existing investors, where you might have an outside lead who's driving like a valuation reset? Like what if founders who navigate that well would do right?
Um, Divide and conquer. I think it's really important for founders to develop one-on-one relationships with their board members.
Mm,
So not, of course, do not like spring it on the board at a board meeting. Okay, that's obvious. But I think also for yourself, for your own sake, um, don't have that first conversation be a group conversation. And not only that, but founders should be developing kind of like these side or one-on-one relationships, really, not conversations, but relationships over time with individual board members, because it's often in the beginning, it's hard to predict, or not just in the beginning, over time, it can be hard to predict who will have power in a board setup, in a board scenario. It's not always the founder. It's not always the chairperson of the board. Sometimes it can be an observer. It's really kind of can be personality driven. And we've been dealing with some tough situation, very unusual, very weird. One day it'll be a Netflix show when we're all done with this situations. And I've seen founders navigating it well by leaning on WhatsApp and having those one-on-one, understanding the motivations of individual board members, getting people kind of like, I mean, I hate to position it like this, but it is like get them onto your side so that you're aligned ahead of time before you have to make difficult decisions. Because it is like ultimately it's a negotiation, but you need to kind of go through. It's like, all those shows about political stuff, like The Diplomat or like whatever. And you know how they're always doing that kind of like hallway type of, I mean, it's real. You got to do that thing. And I think founders that navigate these kind of tricky waters well do that over the course of time and get that pre-alignment before they have to actually get everybody on board with a difficult decision. And then I do think what David mentioned about the newer fund managers is really important. And I think understanding where people's experience sits and then leveraging or kind of like using that to help guide a decision or to your advantage is something really useful. And if it has to be, if your guidance has to come from outside of your board, so be it.
Yeah, I think that there's a piece of advice that I give pretty much all founders, which is like you should never bring something up in your board meeting that you haven't already discussed with all of the individual board members at least once before and gotten their buy-in, because not only do you not know exactly how people react, but when you have this group setting, people will feed off of each other's negativity or positivity. And you can like, I don't remember last time I asked my board for their vote or opinion before I had shopped it with everyone involved. And I cannot understate, like, yes, it's like Diplomat.
Also, can I just say one little other thing, which is your board members are doing that with each other.
Yeah.
So you definitely need to be doing that as well, very actively. And you don't necessarily know. The only way you can know who has strong relationships with whom and who's on what side is by feeling that out one-on-one over time.
Hannah, go ahead. Sorry, please chime in, guys.
Randy, please.
Just wanted to add in on this theme, because I think it's a great one. It's particularly Susan's and your thoughts about having one-on-one conversations. Susan's point about, your investors may not have aligned interests with each other. In climate tech, the funding cycles are elongated, and we find out we have, a strange assortment of bedfellows with, from different sources of capital, sometimes with different sets of motivations and incentives. And so not only are the investors' incentives not necessarily aligned with a company, but they might not be aligned with each other. So having an aggregate conversation with a lot of them is probably not the best way to advance your story. So I agree, the one-on-one conversations, like a venture investor might be different, what they want to hear might be different from a PE investor, might be different from a hedge, might be different from a foundation. So definitely have the one-on-one conversations between meetings.
And I would add this one thing, like, your Series A investors versus your Series B investors, Series C investors, all are priced differently. So they have different motivations. So for many companies, if you hit like a several $100 million valuation, your Series A investors is ecstatic. They've done a 10x. But for your Series and B and C, they need to see, 3 to 5x, and you're not hitting it. So I think that's the key thing you have to understand, is that all your investors will be aligned, and it's going to be a bit like the Game of Thrones, where you'll have Series B investors fighting and Series C investors fighting versus Series A investors. And I think the one thing we need to highlight is that the down round just doesn't happen. It's usually what I like to say is just a slow moving, maybe accident or car crash, where there is first the bridge, right? Ideally, it's a bridge to somewhere, but for many of these down rounds, it's just a bridge to keep the company up and running until everyone figures out what they want to do. That includes at the founder level, that includes at the board level, that includes at the investor level.
Amazing. I think we all went to the same direction of your different investors will have different incentives. You need to know that. And in addition, your different investors may have different capacities to either lead or not lead, right? Especially in these kind of bridge to down rounds. And I think one of the worst and stickiest situations you can find yourself in is also when you're actually trying to get two different board members to kind of play off each other at the same time, where one might have the flexibility to do a flat convertible note structure and the other is convinced that they need to price at a down round. This also can be affected by where those individuals, to Randy's point, where they are in their own fundraising process. Like you need to understand your investor the way you understand your customers. Are they marking up books for their next fundraise? Can they not mark up their books if there is no external lead, for example? Those types of dynamics can sometimes rear their head in funny ways. And then the last comment there about, and this is actually a good way to maybe segue back to David with a question, but you might work with your existing internal members or whoever is leading a down round to think strategically ahead, like 2 steps ahead, about how that round is going to be communicated to downstream investors. One of the most common questions I get with founders working through this is, well, how is this going to play out? Like, what happens in the next round? What do I tell that future Series C investor about what happened here? And being super lockstep with whoever internal or external led that down round is usually mission critical to that future success of it, and documenting, especially in board minutes, where milestones were missed and where you reset them to be achieved at the subsequent round.
I want to like put a big red circle around this point. The last thing you want, so let's say you do your down round and you move on and you go to raise the next round. The last thing you want is for you to tell one story about why you did your down round. And then one of your investors who will get hit up by all the people who are thinking about your current investment, they'll reach out to people without talking to you and they'll get their perspective. And if you don't have the same talking points, that's a big red flag. It's a really big red flag. Hannah, I want to go to you. So like before you have these conversations, I imagine it's a good idea to have your like math really locked down. So what are some of the like what specific kind of scenarios like how should a founder model this and what are the things they need to come to prepared with to all of these different stakeholders? Like what's the financial narrative they need to present?
Heard. I'd be curious to learn from my fellow panelists here as well, but I really see kind of three legs to this stool. It's the cap table and the analysis of dilution for now and future rounds. It's the operating model and kind of runway toward the milestones expected as a result of this round. And then it's the last but not least, it's the waterfall. So if you have things like lick pref, kind of at the end of the day, how does this flow through your share classes and what do you need to believe about outcomes in order to believe that all of your investors are going to meet their returns? Those are the kind of three legs to the stool, in my opinion. On the cap table, I think that's the pretty it's the pretty obvious one when you start talking about down rounds. And to Susan's point, everyone perseverates about price specifically. It's usually the easiest thing to model. Randy could do it in his sleep, and his team does it exceptionally well. I've seen them do it, so go to them. But it's also looking at not just this round, but pro forma out the next round, pro forma out all of the options, all of the warrants that you might give away, all of the convertible note structures and their compounded interest, for example. Like do that work. We talk a lot about scenario modeling in these sessions. The second is that operating model. Like make sure that the down round affords clear milestones from that as a result, and particularly commercial milestones. Like no better way to rouse investors out of bed than to have real, to Susan's point, fundamentals that look really strong as a result of the down round and that you can exceed. And then that third bit on the waterfall is if you have to take liquidation preferences, this also really becomes an important conversation for you to have in the back pocket when you're talking to the potential down round lead investor, internal or external, where you're talking to them about, hey, at what point do we start to talk about things like founder recapitalizations where we can top up various founding employees or option pools or preserve for the employees themselves? Because if and when you exceed certain milestones as a result of the down round, an internal lead can help you negotiate that with future investors if that's something you ever need to revisit. And I mean, I've done that multiple times with subsequent rounds that were even up rounds again and again. Like sometimes that just becomes part of the conversation for keeping the leadership incentivized, but having a clear sense of what outcomes then flow through the waterfall and what do you need to believe there. Those are the three legs, in my opinion.
Uh, Randy, I want to flip the script a little bit. So
Okay.
There are going to be circumstances where founders are like, no, I'm not going to accept a down round. But there's kind of a limit, right, where the board's fiduciary responsibility kicks in. What can we spend a little time on that? Like what at what point do they have to step in and effectively go over the head of the CEO or the founder to make a decision?
Yeah, so we're getting into fiduciary duties. This is a somewhat of an esoteric concept. Let me just try to boil it down, just for people that may not understand or may not know what the board's fiduciary duties are. So the board is responsible for oversight of the management, and in making any decision, they have to exercise their two fundamental fiduciary duties. One of those is the duty, I mean, one of those is the duty of care, and another is the duty of loyalty. The duty of care concerns itself with process, and it's a focus on process and whether the board acted in an informed and deliberate manner. For example, do they consider all available information? Were they appropriately engaged? Did they show up to meetings? Were they informed? Did they evaluate alternatives? And the duty of loyalty is basically for the board members to put their own personal interest aside, including if they're nominated by investors, to put their investors' interests aside and make their decisions and in the best interest of the company and its stockholders. And even if those are at odds with their own personal or affiliated interest. And so with that, sometimes they'll if they go through this process in a deliberate way and they just say that the best outcome for this company is for us to do this down round. I know it's going to be painful to the founders and painful to the employment team, to the employee team, but this is the best way to achieve the company's mission. We're just going to have to do that. And oftentimes the management team does have an interest in this transaction. And so if doing the down round, even though it's going to be harmful to the existing stockholders' equity interest in the company, that's just the call that they have to make. It's different if the company is insolvent or in the zone of insolvency, as David was mentioning earlier at the forepart of this discussion. Then the fiduciary duties of the board kind of extend beyond the stockholders of the company. They start to pick up the interest of the debt holders of the company.
Mm.
And it might be in a situation where, yeah, we can do a down round, but we have if the company's insolvent, we're not really we're focusing our attention also on the debt holders, and we're interested in the debt holder's position as well as increasing or maintaining the value of the equity. And sometimes those interests are not to do a down round, but it's actually to wind down the company and pay out the money to the debt holders, because the debt holders may have some standing under this as saying that the board owed them fiduciary duties.
Yeah.
And they can make a claim against the board for violating the fiduciary duties that were owed to them. So it gets complicated when the company is insolvent.
And I want to throw out just one kind of idea is that I'm a recovering VC, and I like to think I'm a founder first person. And I think the key issue when you're thinking about the down round for founders and employees is how do you protect your common? Because there's many a down round where a disproportionate amount of the dilution will be hit by management and the people who work there. And I think for me, it's always been a very difficult pill to swallow, where the people who work, 7 hours a day, 7 days a week, 12 to 16 hours a day, have very little incentive to keep working at the company. And whatever returns will be won by the VCs. And I think that's the one thing for founders. You need laser focused on how much common you have left and how many lick presses are above you. Which means, just to be simple, if your company gets sold for $100 million, the nightmare scenario is where the vast majority of that money goes all to the VCs and you're left with just a few million. And that has to
Or
be
nothing.
shared across the entire team.
Yeah, or nothing. I mean, there's
Or
lots of
nothing.
stories right now of folks having to sell due to insolvency or underperformance, and because of the liquidation preferences, because of the terms that were negotiated in previous rounds, down rounds, you have, I read a story yesterday where like the entire founding team got zero. They had all left. The CEO who had stepped in, he got a $7.5 million payout. Investors got paid. None of the rest of the team got paid. And like you don't that's a situation that is ideally best avoided. Um, okay, so I'm gonna go to Susan and David. I'm curious, and David, I want you to put your recovering VC hat back on for this one. So what are some of the like operational metrics or structural terms that if you were to lead a down round or fund a down round, what would you want to see in place or committed to by the team in order for it to work? And to sort of to Hannah's point, like, in the financial projections, if you want to show certain commercial milestones, like, is it just commercial milestones or are there other things you'd want to see in place in order to like do a down round? Or is that too hard a question to answer given the broad range of down rounds that you've
Um,
seen?
I mean, I grew up during the internet bubble, 1.0. So fortunate to invest towards the beginning where everything was going up. But I cut my teeth on companies basically going bankrupt because the macro was bad. It wasn't because they were the bad business, the bad management team. They had all these great things. But when the world is ending, it's hard for a great team to rise above all that. And I would say I want to introduce another idea into this is that when we say down round, there is a worst case scenario that happens more often than not called the cram down, where one investor, usually an external investor, comes in and they're the only one willing to write a significant check. All the existing investors are tired, run out of capital, or something else, and they're not really willing to defend their pro rata. And that investor winds up basically saying, I can take as much as come that I want. But the one thing that investor will think about is how do I make sure that the team's incentive to work? Because
Mm,
the worst thing to have is a CEO founder that's just a glorified employee with a decent options package. So the one thing I've negotiated a lot with my clients is that you're facing that scenario. You have to understand that you're the most important person in the room. The business is not the IP. The business is not the brand. The business is the team and the know-how. And if you're not being incented to stay around, you can do something because you can throw the keys back to the investors and saying, until I get an ownership stake that is commensurate or an options
mm,
package that is commensurate with the level of work I've put in, and more important, the level of work I need to put in to make this success for everyone, which is the teams, the investors, I need to see X. Right? So to answer your question, if I'm leading a down round or even worse, a cram down, I want to make sure all the key for hires are incentive, right? And usually like a big broad thing, you want to have 20%, if not more, for management. But at
mm,
the same time, we live in an ecosystem. We live in a village of VCs, founders, advisors, where we all need to work together. Everyone remembers the guy who came in and did the cram down on them in their last round, right? Everyone's incented to
yes, they
play
do.
well together, right? So you need to preserve some upside. And realistically, for a lot of the investors who are tired and don't have the capital to fully support it, you have to allow them to save face, which is saying like, if this company gets sold for $500 million or $1 billion, we still have some upside.
Susan?
I really like what David said, and I want it all to be true. However, I have a couple of things to add, which are um, as the founder, you may be the most important person, or you may be the problem. And your investors will know that or will have decided that, and you need to be honest with yourself about that. I know here in this session there are a number of people that are investors, and so before you like place your bet, make sure that if you get called, that you're able to you may have to step aside, or you may have to, the best thing for the business may be that, you are the problem. Anyway, so there's that. And then the second thing is like, I agree that we are in a village. I think it's more like a city. And the ecosystem is big. And we do kind of see each other again, but every day, every week at least, I'm still learning about new investors coming in that I've never heard of. And it's kind of like the world is just such a big place that sometimes reputational consequences don't come back around, and that's how people can keep doing what they do on either side of the table. So just being kind of honest about that. But I think, I just wanted to kind of put those two things out there, that for founders, you may not be able to, ideally, and it's horrible when the people who are building the company day in and day out have, and I've experienced that, they have like nothing left. But sometimes that's just the consequence. And as a founder, you have to decide what's more important to you, that your project, and many founders view it as their baby, that your baby lives on, even though you have to kind of give your life for it and self-sacrifice, or something else. Sorry, but that's just kind of how it is sometimes.
No, I think I'm really glad that all of these points I think are really important. I would also say that I think that the challenge oftentimes is that as the founder, you don't often have a ton of leverage, right? Like it's not like you're negotiating a down round from a position of strength. Otherwise, you wouldn't necessarily be in that position. And I think it's really, really important that people understand what people care about in the moment. And I think some VCs may care about the reputational risk, and you can sort of like show the stick without necessarily being like, hey, your reputation is going to be at risk if you're an asshole during the transaction. Like, but some VCs might be like, well, and what are you going to do? Are you going to go out and like write a press release? Like, you're not. How is my reputation at risk? And so in some ways, you have to actually be really thoughtful about what levers you push on and how you think about the incentive structures of all the people involved when you negotiate. I don't like, I think it really just depends. And these are all people, right? Like you met one VC, you've met one VC. Like everybody's going to make decisions based on their own internal incentive structure. And it's oftentimes, this is why you want to have these one-on-one conversations rather than try to negotiate this in a group. Okay, I wanna move. We're about halfway through, maybe a little behind on schedule. So I want to move on into like the mechanics and legality of down rounds, because oftentimes this boils down to like what's on the paper. I want to do just a quick round robin. What is one term that if you see it, put your founder hat on, right? If one term that if you saw it in a down round term sheet, you would be like, this is a non-starter. What's one term? And maybe we'll go Hannah, Susan, Randy, David.
I see this more in debt when there are kind of straws being clasped at, but like hate personal guarantees. Do not want to see a personal guarantee ever. My second answer is like pref above 3.
Above 3. Okay. All right. Susan? What's one term that's a non-starter?
Yeah, I'm still just processing above 3. That's that for sure would agree with that. And I was actually just going to say liquidation preferences on a down round at all, because those can be, just really hard to recover from financially for the company. And I mean, just try to hold the line there at 1x maybe, or 2x. That's more important than the actual valuation in the end.
Randy?
Just to offer something different, I agree with everything was said, but maybe full ratchet anti-dilution protection. And if you can't push back on it,
can you define full ratchet for the call?
Yeah, sure. So the investors will be investing in preferred stock, and the preferred stock converts into common stock, usually on a initially on a one-to-one basis. So for every share of preferred stock, it converts into common stock on a one-to-one basis, and it also votes it has a number of votes equal to the number of shares it converts into. So if it converts into greater than a 1-to-1, then they have more than one vote per share of their preferred. Um, you know, if the benefit, a full ratchet anti-dilution protection says that if the company sells shares or equity securities or convertible securities into after my round, after I make my investment at a price below the price at which I bought my shares, then my conversion price switches to that price. And so um, let's just say, I bought my shares for $1. You purchase shares, the company sold shares for 50 cents. My conversion price is now 50 cents. So my preferred will convert on a 2-to-1 ratio.
Yeah, and this is really problematic if you have a down round and then you have another down round. And
Yeah.
all of a sudden your first down round basically is like converts to the new down round. And so you have this total wipeout of the cap table with full ratchet anti-dilution provisions. So yeah, that can be really really dangerous. David, what's one thing that you would like, you're like, this is a
So
non-starter?
I agree with everything everyone else says, but there's another big warning sign. Once the new investor comes in and he crams down all the investors to change into a new share class, sometimes turn into a common or to a new share class, and that new investor will control everything. They'll control the company from a minority position. So that's another thing to watch out for.
Oh yeah. Okay. I I'm just like processing all these red flags. Okay, let's talk a little bit about there are often these things called pay to play provisions in down rounds, which is basically a means of getting uh past investors to pony up to the down round to avoid getting crammed down. And we could talk a little bit about the dynamics there. But Randy, how does pay to play work? What's the intent? And kind of maybe give us like a quick overview of like what actually happens to a cap table if there are pay to play provisions in a down round.
Yeah. So a pay-to-play provision is the new investor or existing investors come in and they want to provide incentive. They have an economic view of the company. They say that the pre-money valuation is X, and we want people to invest at this valuation. And we want participation from the existing investors, i.e., they don't want the existing investors to free ride on the capital that's coming in. So it's intended to provide incentives for the existing investors to invest in the company. Otherwise, they suffer some type of benefit or some type of punishment, or maybe you offer some benefits. But for people who do invest, often sometimes there's a combination. But your typical pay to play, there's different ways to put it in place. But the typical pay to play is um, we're going to convert everyone to common stock. All the preferred will convert to common stock, and they're giving up their preferences, etc. And that's where they'll sit. And then we'll put together an information statement and present the deal to the investors, and they have the opportunity to invest at least their pro rata share or some designed amount of purchase amount into the round of financing. Those who do will enter into an agreement where they get to exchange their newly converted common back into preferred stock. And those who don't will remain in the common stock. And sometimes this pay to play you convert on a 1-to-1 basis. Sometimes the conversion is more punitive, where your ownership of the preferred and the common and the newly converted common are at a 1-to-10 ratio or a 1-to-20 or 1-to-30 ratio. And so not only are you losing the rights if you don't invest your pro rata, not only are you losing your beneficial preferred rights relative to common, but you're in common and your common shares have been combined so that you are occupying a smaller space on the cap table relative than where you were before. So you've lost your rights and you've lost the footprint on the company's capitalization. And those two things working together are intended to incentivize people for not investing their pro rata share. And so it can have a dramatic effect on the cap table. And it could result in a situation where if if a large portion, depending on the degree of the dilution, how down the round is, and the degree of participation from the existing investors, and if there's a reverse stock split on the conversion, if the conversion isn't on a one-to-one basis in the common. In the worst case scenario, the new investors, the smaller number of investors, are taking up an outsized, substantial majority of the preferred and a large ownership stake in the company, and the prior investors are squeezed down into a small stack into the common. And it could result in a situation where it's difficult it's up to the new investment team um, um, to lead the way from that point on. They won't have an existing store of investors to reach out to for co-investment. They'll have to reach out to new investors at the new valuations going forward.
David, I wanted to come back to you for this. So let's say there is this pay to play provision. There's going to be a pretty major recap. Is there Are there things that founders can do to negotiate some protections for themselves and protect their common? And you had talked about this, but I'm curious, like mechanically, what are some terms that founders can try to negotiate in to protect common in this context?
So, like the whole thing, I think Hannah highlighted like the most important thing you need to see is the cap table at the end of the cram down or the down round. And you need to do your own calculation where you're making sure you and your team are getting over 20% of ownership, right? If not up higher. I think that's what you need to fight for. Because
And
again,
how would you actually do that? So like what are some ways that you've seen founders fight for that?
so
What are the typical terms?
I think basically you just have to say we're going to top it off. As
Oh,
concurrent with
like
the
an
closing of this
ESOP or
round, we're going to issue, I don't know, 100,000, 500,000, a million shares that get you from probably like I've seen scenarios where managing the team, their ownership stake fully diluted was like close to like the low teens, get them back to 20%. And just as that's the key thing about keeping this company together, right? Because again, Susan highlighted a good point. Like sometime the founder might be part of the problem, but no one's going to invest in a company where they think all the management is part of the problem. Realistically, like for most founders, your job is to get the company to a certain point, and maybe that might be Series B, Series C, and then you hand it off to someone who's a growth company person rather than a startup
yeah,
person. But again, I think it's just making sure you get enough shares issued or topped off for options. And again, they may ask some new terms. They're like, oh, they're all going to be it's going to be a 4-year vesting period. There's going to be some cliff, or there's going to be some incentive, or specifically for management, there's going to be a lot of performance
yeah,
clauses that you'll need to hit to get it. Right?
yeah,
But again, you want to have that discussion early.
sure. I'm going to move on unless anybody wants to add anything on this. Hannah, let's talk a little bit about process. So, like, how do you guide founders to navigate the sort of data room and investor updates? Like, how much transparency is too much transparency in a down round? Like, what do you typically see the best teams do well?
Sure. On process for managing around, I think David's points earlier were spot on that this often ends up unfortunately being a lot slower and typically is an option of close to last resort in many cases. And so it doesn't come together as quickly or as seamlessly as other rounds come together. It's a lot of more negotiations on the back end. I would say the other elements of the process and like pre-round preparation has been highlighted well in the board conversations we had today. Like the data room pretty much is the same. Like you should have pretty
Hmm.
accurate documentation. I don't really change much about what's happening. If anything, I think there's more of a articulation of why were milestones missed? What assumptions have been proven or disproven? What do we expect from the use of proceeds and the financial position at the end of this round? All of that should be part and parcel with kind of existing fundraising processes, but I think for bridges and down rounds, that's more important on the what needs to be true next. When it comes to how folks are communicating internally and externally what like how the round is going, or rather like we talked about this before, to your future investors, you want to have a super tight story with why this occurred and what the new goalposts are. And getting that, it's often not documented in the process unless you're taking excellent board meeting minutes and board presentations, but getting that written down is really, really critical.
Yeah, I think in my experience, really leaning into the narrative, and having like written answers to the common questions you're going to get from down round investors is really important. It will save you a lot of time, and it will help you to control the discussion in a lot of ways. And so I think oftentimes, and actually Susan, in our first ever, may have been our first ever Enduring Planet Insight, Susan uh, was our expert and talked about how to like create a data room that really helps close rounds. And there were two things she recommended that I'd actually never heard of before. One was to write your own FAQ, right? Of like all the questions you expect to get answered. And then two is to write an investment memo or your own round. And I think for down rounds, those are particularly important because you really want to control the narrative. And I don't know, Susan, would you agree? If it's okay that I'm like parroting your
Yeah,
advice?
it's funny because 4 or 5 years ago I never saw it once, and now it's becoming really common, even just in normal rounds. And I think it's we live in an age of shortcuts, and you can really control the narrative literally by like putting words into people's mouths,
Yeah.
um, especially in difficult to tell stories. Like your investors are struggling for how to bring it to their committees back home. So they will lean wherever they can. And I think that's a good opportunity for the management team to kind of wield some influence.
One thing I might add to this point about scenarios you should have on hand when making these decisions are like, don't let your lead investor hold the cap table or hold the EV to EBITDA multiples to which they're underwriting this deal without you kind of learning that from them. And the best way to do that is to to try to own your cap table scenarios, try to own your even the pro formas, and try to own the financial model such that you can go toe to toe with them in that debate.
Yeah. Yeah, agreed. Okay, I want to ask maybe one last question of Randy before we move into the kind of the last section, which is like, okay, what happens next? But Randy, I'm curious, we talked a lot about this like cram down and sort of the the ramifications for how founders think about dilution. I'm curious, like, how do founders avoid a post down round lawsuit, especially from existing investors who are getting like super crammed down? Are there any kind of like things that founders should do as they navigate the process to really be buttoned up legally, other than like talking to their lawyers?
Yeah, I mean, there's a bunch. It's really about process, and it's not just the founders, but the founders have to. The founders are usually chairing the meet. The CEO is usually chairing the meeting, and they're setting the tone. So one, good counsel, someone who's been through it before, even a special counsel, but also evaluate the litigation risk. Evaluate the likelihood of litigation. Like if we get sued, who is it going to come from? Is it going to come from the ousted founder, a founder from a first generation founder or some early employees? Is it going to come from, is it going to come from a seed investor? Um, and one thing to evaluate there is it's not necessarily an immediate case, someone trying to unwind or set aside the transaction or stop the transaction. Oftentimes, it's when we see these cases come up, it's where the company goes through a down round, turns the corner, does well, and then sells itself for 100 million or a billion, $2 billion. That inspires people who said, well, I was an investor in that company 5 years ago. Where's my share? And then they launch a claim. There's some seminal case law on that. And so you want to establish the record. You want to establish the record, and the record should show that the full board, not just the founders, but the full board were aware of their fiduciary duties and discharge them, not just the founders, but the full board, and that they were mindful of the conflicts. Where there were conflicts of interest at the board level, they were disclosed and they were made known to people. You'd want to show that the board was deliberate. Hannah talked about the model, the financial model. I think that when the board is evaluating the deal, it received that financial model, and where there's a record that shows how the board was aware of how the financing transaction impacted the various constituencies on the cap table. Oh, the common aren't doing so bad, but this round, but the people or the common got crushed. And they took all that into account and still came up with a determination. The worst thing that could happen if you're in the Delaware Chancery Court and people are looking back at this at hindsight, and if the record doesn't show a strong deliberative process, and that the board never received the financial model that showed the impact of the round on the cap table, they're not going to give you any credit for it, even if you did. So make sure that the board is at least receives the financial model and have the minutes reflect that conversation. Assess information. Did they get reports from the financing team? Did they understand where the company was on the runway? Did you have to pull the trigger on the down round now or the pay to play now? And so what you want the record to show is we weren't asleep at the wheel and drove the company into the wall and we had to do this, but rather this was a long drawn out deliberative process where we took into account all information that was available to us. We were deliberative. We took account of the consequences, but on balance, taking all that into account, this was the best outcome for the company. And realizing that it inflicts some short-term pain on some constituents of the cap table, but we tried to be as fair as we could with disclosure and process to the people involved that gave them every opportunity to invest on the same terms that the lead investor invested in. I think if you're able to create a record like that shows a deliberative process, I think you're going to withstand. You're going to best be able to withstand a challenge from investors, and they might not even take the case.
Awesome. Thank you.
Yeah.
Okay, let's shift into our last section. Susan, I'm curious. I want like the real talk answer here, right? So like how do VCs generally view companies that have had a down round? And is it always a dark mark on your history? Or have you seen folks successfully, like even with all the guidance we've given, is it always just a crappy thing you have to navigate? Or are there things that founders can do to show that it's actually, this was a good thing for the company?
I'll be honest, I do think it's a dark mark, just period. However, and this is always really important for founders and also operators to remember, your investors' interests may align with yours, but they're not the same as yours. And oftentimes a down round for an investor that's, categorically interested in your space or that's been watching you for a while is an opportunity. Because they view your company differently, that it's not their baby, it's an asset. And so I'm sorry, that sounds mean, but it's the truth. And that can actually be leveraged to your advantage to attract investors subsequently if you do the rest of the work right. So I think it's a few things. One is obviously, and like this is where people like Randy and David and honestly Hannah as well all come in, which is to make sure that the down round is structured well. And so critical to have real counsel take a look at your terms and help guide you on that so that everything is clean and makes sense. So that's the first thing before we talk about storytelling. And I don't think of it, by the way, just as like storytelling. This is like real actual stuff that you're doing. And also storytelling is a real thing. Which brings me to two, it needs to be a change story. And we kind of talked about this, we touched on this before. What is the change? And I think that's true in any sales pitch. When you're introducing a company, you need to be talking about what's changed between before and now, which is why our company has to exist. But even more so here, the founders that actually come out of down rounds and are like stronger for it are the ones that can not only tell, but actually execute on a change story, on a before and after that incorporates aspects of, the real business milestones, but also sometimes the team.
Yeah.
Sometimes the change has to be you. So, just thinking about what that is and how that should be framed as well. And I guess kind of thirdly, like a down round is a bit of a crisis management moment. And I think that, like, from what I've seen, every founder is confident. Otherwise, you wouldn't be a founder of a company. But crisis founders or successful ones are both confident and honest. I have seen many, many founders come through and try to like do that initial pitch, like super positive, like brush under the rug positioning. They think it's like they're spinning it. Don't do that actually, because investors are really smart and they've probably seen this stuff before. They also talk to each other. They talk to your previous investors. They've talked to people who know you, and there's just no point. I would much rather see, especially in your portfolio, like I've gotten this so many times where I'm just like, just stop. Just like tell me what's really going on and we'll work on it together. I'd rather you be negative with me than be lying, in a sense. And then lastly, I will say, just in climate, we understand that it's a difficult time. These are really long cycles. Companies that can take a down round and survive are often actually really well positioned, because turns out that survival is winning, or survival is your moat if we wait long enough. So maybe that's the silver lining.
I want to talk a little bit. So we talked about sort of the communication with investors. David, Hannah, how should founders navigate the communication with their team, right? And I'm actually curious both throughout the process and after it's signed and done. Obviously, like anybody has an ESOP, they need to understand what the dilution and changes are. But beyond that, like how do the best founders navigate this process with their internal team? Maybe David first and then Hannah.
So I feel most stars are like families, right? So if your parents are arguing, the kids know, right? If they're struggling over raising around, keeping payroll, everyone knows. So you have to be open and honest, but you also have to put a positive spin on it. Like there are many things a founder has to be, but one of the things that he or she needs to be is to be a leader. And it's easy to be a leader when people are throwing $100 million term sheets on you. You're some 30 under 30 list, and your sector, let's say green hydrogen is really hot, but quickly it's not. And how do you pivot? How do you keep the company going afterwards? I think that's the important thing, is you have to be open and honest, but you have to have a vision. And that vision is more than just kind of pie in the sky, like, oh, green hydrogen will be the energy carrier of the future. It's just like, how will your job, how will this company become a valuable, important player that hopefully everyone's options will be worth some money? I think that's one of the key things. And then just one thing I think I want to say before this call ends is that there are a lot of things that happen before a down round. And the one thing that I think is the worst thing is that you're on the drip feed of financing, where you need to raise money. There is no external VC that's going to come in and write you a check. So your current investor just put you on a drip feed, just enough to meet payroll, but you can't do any engineering, you can't do any project development, you can't really talk to customers in an aggressive manner. That to me is just kicking the can down the road. And I think one of the things you need to think about in this world of down rounds is, how do you get your investors saying, we need to fully fund this company or not? If we just kind of drip feed it, kick the can down the road, we're just delaying the inevitable. But that also has to be balanced again with that idea of like live to fight another day. Because I have 2 or 3 companies in my portfolio that knock on wood, 6 months, 9 months ago, I didn't know they were make it. But now they're on the cover of like TechCrunch with great, amazing news.
I think
Hannah?
I think that really resonates. There's a lot of ways to evidence momentum before anything is real, and paper markups are one of those. Valuations and subsequent fundraisers, like that's one way of doing it. But I'll go back to the phrase I've seen some of the best founders anchor on in these tougher times, which is like to be, even if the size of the pie for the team is smaller than anticipated, than desired, to have any slice of a massive pie is a huge outcome. And I think orienting the focus on we've successfully survived to fight another day, and now it's time to focus all that energy on the commercial progress that really does have a chance of moving the needle for new valuations in the future and subsequent fundraising in the future, or getting to EBITDA and cash flow positivity where you're more in control of your own destiny. Like those are some of that focus on not fundraising, but exclusively on running the business, I think is one way of doing that. The transparency piece, I think, is a given, right? And I think, Randy earlier was talking about like these processes are long and drawn out, and then your board needs to show evidence of deep deliberation. Like those words are death sentences to many of the founders operating in these environments where they really are up against cash runway, which is losing month by month more and more leverage they have for any optionality. I think, therefore, like getting through to the other side where you feel like you can maintain momentum focused on what it is that you're executing, what those next milestones are, the next customers, and keeping that urgency, like the fire beneath that urgency. I think those are some of the ways to keep pushing.
Awesome. Thank you. Let's do a last round robin. Um, I want everybody to say one piece of advice that they haven't given yet during this call for founders who are like waking up tomorrow and realizing that they need to do a down round. And maybe we'll go Susan, Randy, David, Hannah, just to close out the call. And then we'll have a little bit of time at the end for maybe last minute questions from them.
Like I said too much before, because I definitely do not have anything new. I'm like all tapped out, and I'm also the first to go. But I guess seek counsel. I've kind of said that already, but like
Yeah.
we have, for example, on our team, one of our partners has been the CFO of public companies. He's been general counsel of public companies. So he's been on all the sides, and also this individual is like kind of near retirement age, and he's like made his money and he just does not give an F, a person like that in your corner to tell you the truth and give you real advice. And he's just like the wisest person. So understand if there's that person maybe within your board, within your broader circles, or within some of the investment committees that you touch, because that can be incredibly valuable. And like the times that he's come through with something creative, or like that nobody else on the board, he's not on the board of some of these companies that I am on, but nobody else has thought of, is non-zero. So I think sometimes just kind of like digging deep and understanding what your real resources are would be my thing.
Great. Thank you. Randy?
I would say, I mean, it's broad advice, but be deliberate and decisive. My wife says that, your half of your job is having conversations that no one else on this planet would want to have. But you can be, where I see companies get into trouble is where the management team is passive and they just drift down the river and not paddle. Um, Force the hard conversations early, and it says, and get off the drip path, as David says, get off the drip path of just funding along the way, but just come up with a vision of what you want, and if and paint a picture of where this company is going to end up if it's just on its current path, and and chart a path for that reality, and that is having difficult conversations, making the ask for a larger round of funding and be willing to accept. And if that's a down round financing, be willing to accept that consequences, but get through it. Because if you let it lapse for a couple years, I think the chances for success are I think the chances for success diminish.
Great. David.
The valuation you have now is not the value at the end of the company. Valuation is a paper number, and the number you're fighting for is to have a big exit at the end. And sometimes it's a windy, circuitous up roller coaster path where your valuation will be going up and down. But what you're fighting for is to keep this company alive, get your product to market, and show that you're valuable to the world so that some medium to large company will want to buy you.
Love it. Want to echo everything that these speakers have brought to the table today. Thank you so much for your invaluable wisdom and for being here with us. My final comments here, if I were thinking about advice, is a down round is a symptom that capital markets do not agree with your prospectus of the company. They do not agree with the same exuberance that you believe the company will grow. So to Susan's points, get yourself the right advisors, make sure you're surrounding yourself with the right resources to fundamentally ask yourself, am I deluding myself to believe that there is something more there? Or do I agree that I could be the problem or that there isn't something fundamentally working about what I'm building? And if the answer is you disagree, do whatever it takes to close the deal and get on with building the thing.
Wise words, you guys. This was awesome. I'm really grateful. Do folks on the call have any final questions before we wind down? Yeah, definitely do not trust AI to give you advice during a down round. Maybe a good starting point, but just remember, AI will give you a definitive answer with a lot of confidence that may not be definitive or actually appropriate. So please exercise caution. Also, maybe to piggyback on that, don't argue with your lawyers about how to do things based on advice Claude gave you. That is not generally a good position. Yeah, there you go. Okay. Thank you so much for everyone who attended today. This is a great session. We will post the recording and the comments and the sort of a summary of all the things that we talked about next week. We will also be announcing our April event, I think this week. And just as a sneak peek, we're going to be talking about metrics that matter for seed and Series A fundraising. And so we'll be sharing out an invite to anyone who's subscribed to the calendar, but also on LinkedIn and anywhere else you tune in to our stuff. So thank you so much. It's been such a pleasure. And huge thanks to Randy, Susan, David, and Hannah for participating today. Have a great rest of your day, folks.